there seems to be this sort of narrative in these markets now that, even if we see a hike in May from the Fed, that might be the last, and we're way past these jumbo hikes that we saw last year. Is that sort of the right narrative to kind of look at these markets now?
Well, good morning, Yvonne, and thank you for having me on the show. I think the narrative that we're nearer the end of rate hikes is correct, particularly in the developed markets. We are of the view that we will see at least one more hike, and that's because we are also of the view that we continue to see inflation as remaining sticky. And so we think at least one more hike. There may be another, but more importantly, still higher for longer. So we don't subscribe to rate cuts by the end of the year.
So where does that lead to in terms of portfolio construction? I have to wonder, because you have the likes of cash now competing with capital markets. How do you construct, what the right sort of mix of equities, fixed income, and cash really are at the moment?
Well, that's a very good question. I mean, I think the most important thing is always to take that long-term perspective and to try and always remain fully invested. With that in mind, cash now is a real alternative. You're right, with 5% plus returns on offer. So from our perspective, we have now for some time been underweight equities and overweight fixed income. And within that overweight fixed income, it has been more of a barbell. So we certainly had some at the shorter end when you've been able to get those 5% plus returns, but we still feel very comfortable with quality, long duration fixed income as well. Okay.
I'm just wondering, when it comes to the China story, there's been just a lot of doubts, I guess, that the recovery is really kind of gaining traction right now. I take a look at how inflation numbers there are. There's talk of more policy stimulus. How do you look at this market now?
Well, while I said we were underweight equities, and we are as a whole, within that kind of the equity kind of universe, we are overweight emerging markets and we are overweight China. So we are supportive of the reinflation story that we're seeing in China. We think the authorities will continue to support that, both from a monetary and a fiscal perspective over the course of the year. So, and valuations are probably around kind of average historical levels now. So China is one of our preferred markets.
It's interesting that you look at alternatives as well. That was something that a lot of people looked at as a way to kind of protect yourself against inflation. What do you look at in particular there? And is this still kind of a play for this year?
Well, alternatives is an area where we are also overweight, and there are a number of plays. Certainly things such as infrastructure. Infrastructure tends to do well in a high interest rate but falling growth market, and it has done well, and we're overweight there. We're overweight hedge funds because we do expect more kind of beta volatility, so getting that idiosyncratic kind of risk opportunities that hedge funds can often give you. But the one thing I would really look out for maybe later in the year, Yvonne, is I do think there's going to be some really good opportunity in the private markets again, and that's going to be private market debt and private market equity, particularly real estate equity, once we see some more price discovery. So alternatives is an area we're overweight, and certainly one that we're talking to clients about.
Okay, I wonder, in terms of just your kind of outlook when it comes to the U.S. now, is recession becoming more of a consensus call? There's talks that maybe there is a growing risk of a stagflation scenario too in the U.S. Is there a way to best play that in these markets? What's the best way to express that?
Well, we certainly do believe, because of our call on interest rates being higher for longer, that you are going to have subpar growth, and that's probably going to go through a kind of mild recession. The way we would be playing that is that we are a long fixed income, as I said before, because fixed income will do well in that type of environment, particularly as bond rates come off. So, but you're absolutely right. I think the next kind of few quarters, you're certainly going to see growth under pressure in the US.